get that big, but they could involve yield curve relationships or on the run, off the run governments or things like that are just things you learn over time if you're around securities markets. They're not the base of our business. Probably on average, they've accounted for a half a percentage point of our return a year, or 3/4 of a percentage point a year of our return. They're little pluses that you get for actually having just been around a long time and learning a little bit about it. First arbitrage, not the first arbitrage I did, but one of the first arbitrages I did, involved a company where they were offering cocoa beans in exchange for their stock. That was in 1955. And I bought the stock, turned in the stock, got warehouse certificates for cocoa beans, and they happened to be a different type. They were trading in the New York Cocoa Exchange, but there was a basis differential in my favor, and I sold them. I mean, that's just something that I was around at the time, so I learned about. Hasn't been a cocoa bean deal since. 40-odd years. I've been waiting for another cocoa bean deal. I haven't seen it, but it's there in my memory if it ever comes along. And that long-term capital is that on a big scale. Yep. The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game to make a decision and start evaluating businesses. But once you're in the business of evaluating businesses and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need. And you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea. But a lot of people have gotten rich on their best idea. So I would say that for anybody working with normal capital who really knows the businesses they've gone into, 6 is plenty, and I probably have half of it in what I liked best. I don't diversify personally. I mean, and all the people I know that have done well, with the exception, we mentioned Walter Schloss here earlier. Walter diversifies a lot. He owns a little of everything. I call him Noah. He's got 2 of everything. Yeah.